Here's a problem where we are actually planning to build a new assembly plant in another country. So we are a US-based jeans company, but we're building a new plant in Guatemala City. Guatemala uses a different currency, the quetzal. And so when it comes to a final construction payment for building this plant, we have to pay in quetzals 10 million, and that's going to be due in 6 months when the plant's finished. So I like this example because it's a common problem that companies face. And in this example here, with our 10 million due in 6 months to finish building the factory, we're wondering if, as a treasury manager, whether we should be managing that foreign exchange rate risk. The uncertainty, in other words, of how much it's going to cost us in dollar terms to actually pay for completion of this factory. So that's our setup for the problem. And there are 3 questions that we need to answer. 4, if you consider the 4th kind of figuring out which approach is best. But the main kind of questions are, how much is it going to cost us if we just don't hedge at all? How much is it going to cost us if we use a forward market to hedge? And how much is it going to cost us to use a money market hedge? And so if we do hedge, which one's going to be the best and why? Here, we're given a bunch of parameters or variables, starting assumptions, basically how much we're going to have to spend in foreign currency, the current spot rate, the forward rate, the Guatemalan rate of interest, the US rate of interest, and our own company's weighted average cost of capital. That is, if we had $1, what's our sort of annual expected return from us doing business on that dollar? And in addition, we don't know what spot rates will be in reality in the future, but our expectation, our highest expected exchange rate in quetzals per dollar is going to be 8.6. And then we have our lowest, and then our kind of average or baseline scenario expected exchange rate for 6 months from now. So these are our starting parameters. We've got the scenario. Let's first take a look at what we'd pay if we stayed unhedged under a few of these under the baseline scenario and maybe the best case and worst case. And then we can move on to the others. So for our unhedged scenario, our payment in 6 months, we know it's 10 million Guatemalan quetzals, but what we need is this in US dollar terms. We don't know what the exchange rate is going to be in 6 months, but our baseline scenario is that it's going to be 7.87 quetzals to the dollar. So $1 buys 7.87 quetzals. $1 buys more quetzals. So if we're going from quetzals back to dollars, then this number should be smaller. In other words, we take 1 divided by that expected spot rate in 6 months from now, which for us here in this example is going to be that 7.87. And so that means in dollar terms, what we're going to end up with is $1,162,791. But of course, we don't know this is the actual amount we're going to have to pay. It's just based on our expectation of what we think the spot rate is going to be 6 months from now. So B and C here are where we're actually going to do some exchange rate hedging to eliminate that uncertainty. So part B asks us to calculate how we would go about getting rid of this exchange rate risk using a forward market hedge. And so for a forward market hedge, you still have to pay the 10 million quetzals 6 months from now to finish the factory. It's just that with forward rate hedge, you're locking in the rate at which you are transferring one currency for another. In this case, we're going to be selling USD and buying quetzals at an agreed upon forward rate. And we're given that. In reality, you would go to different banks to kind of get price quotes for different forward rates. But for this problem, we've got 7.65. So it's going to be very similar to what we did in part A. We just take the forward rate, 1 divided by that number, and that's what we're converting to, that's what we're converting our dollars to, is at that rate, that forward rate. So for us, it's at 7.65. That means that in dollar terms, using forward rate to hedge, it's going to cost us $1,307,000 and 190. So you can see the forward rate approach is pretty simple. We sort of just treat it exactly like we're converting at the spot rate. It's just that what's going on behind the scenes is different, is that we're going to a bank and just kind of exchanging our money with them, and the rate of exchange is pre-specified ahead of time. So that eliminates our risk in contrast to part A, because we've specified ahead of time the rate of exchange that we're going to convert those 10 million Quetzals to. Part C, the money market hedge, is where it gets a little more tricky. What we've got here is an accounts payable. Today, we are sitting around, and later we're going to build this factory in another country, and that means that later we're going to pay 10 million Guatemalan Quetzals. So it's like an accounts payable because we've incurred it today. We're going to have to do it, but we haven't actually paid for it yet. And so with an accounts payable money market hedge, kind of the idea here is that we take the money today, a certain amount of dollars, go put it in a Guatemalan bank account, and therefore today we're kind of converting the currency at the spot rate, and then it just sits in the bank account earning rate of interest. And when it comes time to pay off for the construction of the factory, well, we've already got the Guatemalan Quetzals ready to go, and so we can go and pay it off. So the question is, how much do we convert today? And how much dollars do we need given the spot rate today and the fact that we're parking it in a bank account, and that's earning a rate of interest. So we can use some of that interest to help pay off this accounts payable. So let's take a look at that with numbers instead of just a bunch of squiggly lines. We've got an accounts payable, and that's going to be 10 million Guatemalan Quetzals. What we're going to do is convert dollars into Quetzals so that we have 10 million Quetzals, which is what we need to pay it off. But when we convert it today, we're immediately going to go to a Guatemalan bank and park the cash, because why not? I mean, we might as well earn a rate of interest for the 6 months until the payment is due, rather than, not earn money. So that's why the 2 is there, because I'm talking about annual interest rate here, and we're only looking at parking our cash for 6 months, so half a year. And for Guatemala, interest rates are higher than that of the US. And so the actual numbers that we're going to use here, 16% is the annual rate of interest for Guatemala, for bank accounts in Guatemala in this example. And we're parking it there for half a year. And so let's just calculate that before we move on. When we calculate and simplify this, we get 9,259,259. So these are Quetzals. What we're kind of seeing here is that we don't actually need the full 10 million to pay off the 10 million that's due. What we can do is today deposit that money, a certain amount of money. In fact, we can deposit 9.25 million Quetzals into a Guatemalan bank. And because we're earning a rate of interest for 6 months, we're earning a total rate of interest of 8%. We don't actually need the full 10 million. If we deposit 9.2 million, it'll earn enough interest such that the principal plus the interest combined equals the 10 million Quetzals needed. But the problem to begin with is that we don't actually have Quetzals, we have dollars. And so we need to figure out how much this is going to cost us in terms of dollars. To do that, we take the Quetzals that we're going to need and convert it using the spot rate. Just like we've seen before, 1 divided by the current exchange rate. Because remember, it's today that we're going to convert our dollars into Quetzals and then deposit it into a Guatemalan bank account. And so for us, that conversion, today's spot exchange rate is this 7.50 Quetzals to the dollar right here. So 1 divided by 7.50, which can be written in decimal form as 0.133. That's going to be our conversion into what this is in dollars. And that in dollars, you may get slightly different numbers depending on rounding, but it should be very close to $1.234,259,000. So that's it. With this accounts payable money market hedge, this is the amount of dollars that we need to convert today, park at a Guatemalan bank, and then use the ultimate proceeds to pay off this loan in 6 months. This factory payment in 6 months. Now, that's pretty much it, but there is one addition that we need to do specifically for this problem, because the problem is asking us in part D to compare methods B versus methods C, the two hedged approaches. And the difference between these two approaches is the fact that with the first, we kind of keep our money in US dollars for the first 6 months. And then when the forward rate comes due, the time to make our payment comes due, then we translate the dollars into Quetzals and do our thing. With C, though, we've taken our dollars and immediately spent them, converted them into Quetzals today, not 6 months later. So there's a time value of money kind of component to this. If we convert to Quetzals today, we don't have those dollars to run with at our opportunity cost of capital, our weighted average cost of capital. So if we want to kind of effectively add that cost back in, the cost of not having this money for 6 months, remember our cost of money is 20.5% here. Then we have to add our weighted average cost of capital back in here. And if this is annualized, then we, since it's 6 months, half a year, then we basically add in 6 months worth of weighted average cost of capital. So that was 20%. So we can add those numbers here. And then that simplifies down to 1.1025. And so overall, our cost in dollars for this approach using a money market hedge is going to be $1.361 million. So slightly higher than our original 1.234 when we're accounting for the cost of money, the cost of capital. And so then if we are going to answer the final question, which method would you select and why? At this point, since it's an accounts payable, we can just pick the one that's least expensive. The money market cost us, if we include the time value of money, 1.361 million. If we use a forward market hedge, it's going to cost us 1.307 million. So which hedge is better? In this case, it's the one that costs less. It's the forward market hedge.